You know when the cashier offers you 20% off if you sign up for a store card? Well, what if I told you that up to 50% of people who sign up for these cards actually end up regretting it? These are called retail credit cards, and the industry has hundreds of millions of accounts, around $300 billion in outstanding balances, and annual revenue exceeding $13 billion from interest and fees. So when and why did our favorite retailers become banks? Well, in this video, I will uncover the psychological tactics retailers use to get you to sign up for these cards, the surprising statistics on how retail cards stack up against normal credit cards, and the ethical concerns surrounding these practices. So to start off, retail cards tap into something called hyperbolic discounting. We humans prefer instant gratification. We'll take a smaller reward now over a bigger reward later. Our brains light up when we see a discount right in front of us, while we ignore things like interest and fees down the road. 20% off just hits different when you're already feeling that shopping high. Then there are those fancy loyalty programs with tiers, points, and status levels. Surveys show over 70% of cardholders admit that these make them spend more. The points and perks make us feel valued, but truthfully, they mainly just drive more spending and more debt. So when every store is pushing their cards, that starts to feel normal, expected even. But owing a bunch of money to retailers just to get some sale price, that's like quicksand on your finances. Studies show most users don't understand terms like APR, but keep swiping those cards anyway. And for status seekers, flashing an exclusive store card just feels so good. It makes us feel like we've arrived, you know? But chasing elite cards often leads to overspending just to feel special. Surveys show 40% of retail cardholders admit they spend more than they can afford. So let's be real. Swiping those logo cards gives us a rush, like winning at a casino. Retailers have turned shopping into financial slot machines, training us to crave points and redemptions. But is that dopamine hit today worth years of interest and fees for most people? Well, over half of card users said nope, not worth it. So once we've sunk time and money into the rewards, the sunk fallacy cost kicks in. We keep less than great behaviors going on to avoid wasting our efforts. Studies show over 80% of users feel compelled to shop more so they don't lose their points and perks. And now by targeting our ego, desires, and dislike of loss, retail cards hook us in, turning our own minds against us. But are these little psychological wins really worth the financial traps? Okay, before looking at retail cards specifically, let's talk about how the credit card business works overall. This will give us some context. So at a high level, credit card companies make money from interchange fees charged to retailers, interest paid by consumers on balances, and those pesky late fees and penalties. Retailers pay interchange fees as a percentage of each transaction. Interest and fees come from customers carrying balances. So this model thrives when consumers take on more and more credit card debt. As of 2022, Americans had a whopping $930 billion just in credit card balances, according to the Federal Reserve. And with minimum monthly payments between 2 to 3%, consumers stay stuck paying interest way longer than they need to be. For example, $1,000 of debt on a 20% APR card with a 2% minimum payment would take almost 20 years to pay off and cost over $1,000 in interest. Card companies definitely win when you're forever paying down tiny bits of debt. The complex fine print agreement allow card issuers to raise rates and fees anytime for any reason. But let's be real here. Most people don't actually read through all of those pages of confusing legal jargon. This lack of transparency just helps issuers profit more off debt. And over the years, regulators have tried to improve credit card fairness and transparency, but they're also worried about burdening the credit card industry too much. It's a delicate balancing act for them. Alright, now that we've reviewed how the credit card profit machine works, let's look at how retail cards differ from old school credit cards. Most retail cards offer loyalty programs and points instead of simple cash back like general cards. This ties spending directly to one retailer instead of providing flexible rewards. Retail cards also tend to have crazy high interest rates. We're talking over 20% versus 10 to 20% for general cards. Penalty rates can hit 30% or more. That's potentially painful levels of interest. Also, retail cards usually have lower approval requirements than traditional cards too. Easier access leaves financially vulnerable shoppers at risk of racking up high interest charges. And since retail cards can only be used at one store, people often open up a bunch of them to chase discounts and rewards. This leads to overspending compared to having one flexible card. Retail cards tend to have lower credit limits as well. This seems safer, but actually makes managing debt trickier. Also, general purpose cards have stronger fraud protections and accountability than retail cards. Oversight remains more limited on private label credit. So in summary, retail cards have come with their own set of financial risks compared to old school credit cards. Now let's move on to shedding light on the potentially dark side for consumers. So retail cards lure us in with big discounts up front, then bury us under outrageous fees, sky-high rates, and ridiculously confusing terms down the road. According to Consumer Finance Protection Bureau reports, penalty fees alone collected from retail cardholders exceeded $1 billion annually in 2021. With pages of fine print, even small slip-ups can trigger fees and rate hikes that drive balances out of control. Missed payments lead to penalties, which lead to more debt and more missed payments. It's a nasty downward spiral. Most retail card users have very limited financial literacy on credit, but research shows only 14% of issuers provide any education, since they benefit from clueless consumers instead of informing them. In my opinion, penalties for even minor retail card misuse constitute predatory lending, but they continue unchecked as consumers bear the lasting credit damage, not the issuers. Since 2018, the CFPB has gotten 5 times more complaints about retail versus general purpose cards, but oversight and regulation still lag compared to general credit. So while old school credit cards have added consumer protections, outdated regulations still govern riskier retail cards. Alright, so in summary, we've seen the potentially dark side of how retail cards can harm consumers. But that begs the question, why are retailers still pushing them so hard at checkout? So retail cards increase customer loyalty and retention. Shoppers spend more over time to earn rewards and avoid losing their points and elite status perks. Studies show retail card users spend 2 to 4 times as much as non-card users. More spending means more sales and revenue for retailers. Retailers also get all that valuable data from card applications and transactions to conduct targeting marketing. Individualized promotions improve conversions across diverse shopper types. And retailers earn profits from interest and fees paid by their own cardholders. So consumers bear the burden while retailers enjoy the payouts. Unlike general cards, retail cards have lower interchange fees. This saves retailers money on each purchase made with branded retail credit. In-depth analytics on high-spending loyal customers gives valuable insights into customer lifetime value, a marketing goldmine. So now that we've followed the money trail, let's look at the manipulative tactics that retailers use to promote their cards. Okay, so this is where it gets sneaky. Retailers have all kinds of tricks to get us to sign up for those store credit cards. Let's look at some of their manipulation tactics. First, they lure us in by offering big discounts instantly when you open a card, before you even spend anything. Research shows that discounts early in the process increase applications by over 80%. 20% off right now just seems pretty hard to pass up. Then, there are those fancy reward programs to keep you spending more once you're hooked. The high tiers, bonus points, and VIP perks. A 2022 McKinsey study report found over 60% of card owners felt pressure to spend more to maintain their elite status. Also, retail employees face intense pressure from corporate sales goals to sign up customers for store cards too. A 2022 report found workers at some chains were threatened with firing if they didn't meet their daily application quotas. Also, big retailers like Target and Walmart run special promotions tied explicitly to signing up for their cards on the spot, and they pay close attention to identify less financially literate shoppers to market cards to aggressively. Over 50% of low-income households have retail cards versus under 10% of high-income households, according to the FDIC. No coincidence there, right? So, in summary, psychological pressure and manipulation are the retail credit marketing strategies. Now, let's talk about the ethics of these cards. I'm just gonna say it. Retail cards reflect big corporations callously profiting by exploiting common consumer weaknesses. It raises some serious ethical questions in my mind. Credit regulation history has prioritized protecting the industry over consumers. We need deeper reforms to rein in predatory retail lending practices. Retail cards drive consumers towards over-indebtedness while providing limited economic value from customer loyalty programs designed to benefit retailers. With retailers profiting directly from their own cards, you've got to wonder about the serious conflict of interest and how these programs are managed and marketed. The value exchange seems dangerously tilted, with corporations benefiting way more than consumers from psychological manipulation. But now that we know how the retail credit card game is stacked up against us, let's talk about how to avoid these traps. Using general rewards cards responsibly can help consumers earn similar discounts without accruing multiple high-interest retail balances. And debit cards and cash provide access to sale pricing while avoiding burdensome credit obligations. So improving financial literacy helps shoppers recognize and resist retail credit card marketing ploys. So make sure you get educated to see through all of those retail credit card tricks. Be sure to carefully scrutinize terms, do the math, and calculate the total cost before signing up for any enticing retail card offers. The hype usually exceeds the reality. So to protect consumers, regulatory reforms around transparency, fees, and rates need to catch up to modern retail lending practices. Meanwhile, corporations should rethink loyalty programs to provide ethical win-win value without relying on consumer debt. So the bottom line is, shop smart, know your rights, and don't let them mess with your mind or your wallet. Until next time.